Welcome to vTalkInsight, Market Drivers Daily from March 10th, 2026. The Middle East energy shock is colliding with surprisingly resilient risk assets, raising urgent questions about how long this disconnect can hold. Let us unpack how geopolitical tensions, volatility, and supply chain stress are shaping today's cross-asset landscape. Geopolitics remain the dominant macro driver, with the Iran conflict and the closure of the Strait of Hormuz keeping global risk premiums elevated. The probability of a severe market meltdown over the remainder of the year has been raised from 20% to 35%, largely because of heightened geopolitical and credit risks tied to this energy shock. Compared with yesterday, when oil was consistently trading above $100, prices have now dropped back below that level and closer to 90. Yet they're still up sharply year to date, and the conflict around the strait means a durable pullback is far from guaranteed. On the ground, the picture remains tense and complicated. The Strait of Hormuz is effectively closed to commercial shipping, with only a trickle of vessels getting through, and around 200 ships reportedly trapped, threatening roughly 20% of global oil and gas flows. Output cuts across Saudi Arabia, the UAE, Kuwait, Iraq, and others add up to about 6 to 7 million barrels per day, or roughly 6% of world supply, while recent attacks on tankers, refineries, and other infrastructure reinforce the sense of a structural supply shock. Officials from Aramco describe this as the most severe crisis the region's oil and gas industry has ever faced, and historical patterns suggest that persistent oil shocks have often coincided with recessions, bear markets, and equity drawdowns of 10 to 15% or more. Despite that backdrop, asset prices still imply that the conflict will eventually be contained. Equity markets have been hit, but moves remain relatively modest outside the most exposed sectors, and recent sessions have even seen rebounds in Asia and Europe as talk of a quicker end to the Iran war circulates. Investment-grade credit spreads remain historically tight, under 100 basis points, and large, multi-currency bond deals from companies like Amazon are being met with strong demand, while the global IPO pipeline is still expected to reach around $200 billion this year, unless geopolitics deteriorate further. Part of that apparent resilience reflects the view that the United States is now less vulnerable to oil shocks, with estimates that current price levels subtract only about 0.1 to 0.2% from quarterly GDP, whereas Europe, with higher import dependence, looks more exposed on the inflation and growth front. Flows and hedging patterns highlight how investors are responding to these tensions. Over $100 billion has moved into bond ETFs in the first 2 months of the year, a record pace since 2007, and demand for perceived hedges is strong, even though traditional safe havens like gold have underperformed recently because high treasury yields raise the cost of holding it. Some forecasts now point to gold potentially reaching $6,000 per ounce by year end, and even higher by the end of the decade, underscoring how persistent geopolitical stress can support demand for diversifiers. At the same time, private credit is flashing early stress signals, with large managers imposing withdrawal caps and borrowers facing higher refinancing costs as energy-driven inflation and delayed rate cuts keep funding conditions tight. Key watch points now include tanker traffic through Hormuz, any credible ceasefire framework, concrete decisions on strategic reserve releases, and how quickly equity and credit risk premiums adjust if today's optimistic de-escalation narrative fails to materialize. Volatility has become a story in its own right, not just a byproduct of geopolitics. Crude has seen extraordinary intraday swings, with Brent moving almost $36 peak to trough in a single session and, at one point, trading for nearly $120 down to the low 90s. In other episodes, prices have dropped from around $120 to the mid-70s in less than 24 hours, highlighting how sensitive markets are to every headline on the conflict, shipping lanes, or potential reserve releases. Oil options markets are reinforcing that message. Skew has inverted in both short and 6-month maturities, a rare pattern that signals expectations for a prolonged period of elevated prices rather than a quick spike and reversal. Recent trading has shown how even small communication errors can trigger outsized moves. A deleted social media post about U.S. Department of Energy activity sent WTI briefly to a session low around $76 and sparked a rapid drop before prices recovered. While another erroneous headline about U.S. Navy operations in the Strait of Hormuz drove an intraday swing of roughly 20% in crude futures. Bond markets are also volatile, with yields reacting to the tug of war between higher inflation expectations from expensive energy and weaker growth prospects. Long-dated yields have been grinding higher, and intraday moves in key maturities, including the 30-year sector, have widened as traders struggle to balance stagflation risk against the possibility of delayed or smaller rate cuts. This volatility is translating into real P&L stress. Several major hedge funds, including large multi-strategy platforms, have reported significant losses linked to synchronized risk-off moves in equities and bonds after sudden escalations in the Iran conflict. Across markets, correlations have risen, equity factor dispersion has narrowed, and volatility indices have pushed higher, consistent with a regime shift away from idiosyncratic, stock-specific drivers and toward macro headlines dominating price action. At the same time, there are signs of mechanical de-risking as wider ranges force higher value at risk calculations, nudging investors to trim exposure even in the absence of fundamental capitulation. There are, however, important stabilizing elements to keep in mind. Despite 5 sigma-type moves across several markets in recent days, trading systems, margining, and settlement processes are functioning smoothly, and there is little evidence so far of systemic banking stress linked to this episode. Historically, markets have often rebounded strongly once geopolitical uncertainty subsides, and some investors are already positioning selectively for that possibility. For example, in software names and other growth sectors that have derated during the risk-off phase. Looking ahead, volatility is likely to stay elevated as long as policy uncertainty is high. Energy remains expensive, and the path of rate cuts is unclear, which argues for shorter forecasting horizons and a greater focus on scenario analysis rather than a single base case. The next catalyst for this volatility regime are incoming CPI and PCE inflation data, central bank signals on how much energy shocks could delay easing, and any credible progress on securing shipping lanes. Beyond prices and volatility, the real economy is now feeling the strain through disrupted supply chains. The Strait of Hormuz remains effectively closed to normal commercial traffic, with only minimal passage reported and roughly 200 vessels stuck, turning a vital corridor for about 20% of global oil and gas flows into a bottleneck. Shipping companies face severe operational uncertainty, as there is still no formal naval escort arrangements in place, while signal jamming and interference with vessel tracking systems make it harder to monitor movements in real time. Maritime insurers estimate that hundreds of billions of dollars in coverage would be required for shipping to resume at scale, which underlines both the perception of extreme risk and the force majeure nature of the current disruption. The direct energy impact of these bottlenecks is already substantial. Roughly 6% of global oil production is offline due to Gulf disruptions and related output cuts, and producers are increasingly constrained by storage limits, forcing more barrels into offshore storage and deepening production curves. Asian markets are on the front line of this shock, with acute supply stress and price dislocations in benchmarks such as Dubai crude, even as Indian purchases of Russian oil and Japan's sizable reserves provide partial buffers. Policymakers are evaluating their options. A coordinated strategic petroleum reserve release of around 400 million barrels could cover 45 to 50 days of current Middle Eastern losses, but would likely need to be rapid rather than gradual, and even then it would only smooth, not fully erase, the underlying shortage. The second round effects along supply chains are becoming more visible in sectors beyond crude itself. A drone strike on the UAE's largest refinery, which processes about 900,000 barrels per day, has contributed to an outsized surge in jet fuel prices, which are up as much as 150% week on week and have risen far more than Brent. Airlines are responding. Qantas has raised international fares by about 5%, and analysts warn that jet fuel costs, which can account for up to 40% of airline expenses, could erase around 10 percentage points of margins, if not offset. If elevated fuel prices persist, carriers may reduce aircraft utilization and delay new orders, creating knock-on effects for aerospace manufacturers and the broader industrial supply chain. Food and manufactured goods are also in focus. Higher energy and transportation costs are already lifting prices of wheat and other soft commodities, and there is concern that fertilizer flows from the Gulf could be disrupted if the conflict drags on, which would complicate planting decisions for major importers such as India. New supply shocks in consumer electronics and key metals are also expected to push goods inflation higher in coming months, even before fully accounting for Middle East tensions. Corporate commentary is starting to reflect these risks. Companies like Volkswagen note that long-term contracts have so far insulated them from immediate cost increases, but warn that a prolonged period of instability would eventually pressure supplier pricing and consumer demand. Against this backdrop, markets are likely to scrutinize upcoming earnings seasons, logistics data, and any signs of normalization in Hormuz traffic or shipping insurance, which will be crucial in determining whether today's supply chain fractures prove temporary or more structural. To sum up, Middle East tensions keep the probability of a severe market event elevated, even as oil prices retreat from recent peaks and risk assets show resilience. Volatility remains extreme across crude, bonds, and equities, challenging traditional risk management and reinforcing the need to think in scenarios rather than single-point forecasts. At the same time, supply chain disruptions centered on the Strait of Hormuz are amplifying the energy shock and rippling into airlines, food, and industrial sectors, with policy responses and logistics developments set to determine how lasting the damage will be. For now, careful attention to tanker flows, policy headlines, and inflation data looks critical in gauging whether the current disconnect between macro risk and market pricing can persist. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.